This is Matthew Cratter from Trader University, and today I want to talk about how to make money with SPACs. These have been very, very popular in 2020 and 2021, and as you can see from this chart, they've really raised quite a bit of money and come into their own in the past 12 months. If you've heard about what happened with Nikola, DraftKings, Virgin Galactic, these are examples of private companies that have come public by way of a SPAC. Now, there are different ways of going public, and to talk about SPACs, we really need to understand what they're replacing so we know what the advantages and disadvantages of them are. So when a company goes public, it basically goes from being a private company to a publicly traded company. A publicly traded company is just a company whose stock trades on a major exchange like the NYSE or the NASDAQ. Now, why would a private company want to go public? Well, the main reason there'd be two main reasons. One is to tap the capital markets, to raise capital in order to grow the business. So if you're Facebook, you're very small, you've received funding from venture capitalists. At a certain point, once you know that you have a strategy that's working, you want to go public, you want to issue shares, raise a bunch of cash, and use that to grow your business. Obviously, the other reason to go public, to have an IPO, is to allow some of the original investors and founders, whether VCs or the entrepreneurs who started the company, to allow them to get some liquidity and sell their shares. It's much more difficult to sell privately traded shares. It's highly regulated, it's very illiquid, and they're wide bid-ask spread. So these are the two main reasons, if you have a company that is private, why you might want to take it public and offer shares to the public. This is called an IPO, initial public offering, when a private company goes public and begins to trade as a publicly traded company. Now, the traditional problems with IPOs have been there's lots of regulation, there's a lot of paperwork, there are very high fees that are charged by the investment banks, often somewhere between 3 and 7% of the amount of money raised. If you're raising a few $1 billion, you can see how much money that translates into in dollars. The other problem with IPOs is that investment bankers will traditionally underprice your stock to entice institutional investors to buy it right before it starts trading. And then what happens is it comes out at it starts trading with what's called the IPO pop, where it pops on the first day or the second day. But what this really means is that the company did not raise as much money in the IPO as it otherwise could have because it was underpriced by the investment bankers in order to create that pop, that IPO pop, and all of the buzz that surrounds it. The other problem besides the fees and the underpricing of the IPO is you have to go on a roadshow. This can be very distracting, especially if you're on the executive team. You're more interested in how to grow the business, etc. Roadshow, you have to travel to cities all over the country or all over the world, talk to institutional investors. They're going to want to talk to the CEO and the CFO and basically find out why they should buy your newly issued shares. So this can be very time consuming, and it can be really a huge distraction from business. And then after you've done all this work and paid all these fees, it may turn out that you come public at a price that you don't really like, that the market, for some reason, doesn't value your company. Maybe it doesn't understand your company, but it doesn't value it as highly as you would like. So you've gone to all this trouble and you paid all these fees, you've done this roadshow, and then you end up with an IPO price that you don't like. And the company also doesn't raise as much money as it otherwise could have because it's being underpriced by the investment bankers. Now, the nice thing with a SPAC is that you know in advance what price you will get when you go public. And we'll see how these negotiations work. So what is a SPAC? A SPAC is a special purpose acquisition company. It's an alternative to an IPO. It's another way for a private company to go public. You may have also heard about direct listings. We're not going to talk about them as well. But the IPO is really the traditional way to go public. And now the SPAC has become a very fashionable and a much easier way to go public. So this is how it works. If you want to set up a SPAC, you're basically setting up a shell company, often called a blank check company, because this is just a company that exists on paper. It has no assets. It has no operational business. It's what's called a shell company. Now, the shell company has people who are managing it, a management team, which is usually called the sponsor or the sponsor group. And the shell company does an IPO. Now, it's very easy to do an IPO for a shell company because you don't have to enumerate all the assets that you own, because the company basically owns no assets, and you also don't. There's no associated business. There's no operational business there, and so you can go public at a much lower cost. And basically, what you do is you sell shares in yourself in the SPAC in order to raise cash. Now, SPAC shares, or SPAC units as they're often called, are often priced at $10 per share, $10 per unit. And so let's say you sell 100 million shares. Basically, a SPAC is like a pie, a pumpkin pie. You can divide it into as many slices as you want. Let's say we divide it into 100 million slices, and we sell each slice for $10. And if you're someone famous, or if you're an investor like Chamath or Peter Thiel, and you have a really good track record, people will be willing to give you this blank check and buy some of your shares at $10 each. So if you sell 100 million shares in the SPAC at $10 each, you raise $1 billion, and then that cash that's raised gets locked up in a trust account, in basically a lockbox, and it can't be used for anything except to buy a private company or to take a stake in a private company. So now that you've raised $1 billion as the SPAC sponsor, it's time to go find a private business to buy a piece of. So let's say I'm the SPAC sponsor. I find a private business that I think is worth. I look at the fundamentals. I look at they give me their financials, and I think the business is worth about $9 billion. So I go to the owners of the business. Again, this is a privately held business. There are no publicly traded shares. I go to the private owners and I say, based on market comps, I think your business is worth about $9 billion for the entire business. I want to give you $1 billion in cash, which I've raised from the SPAC. And now your operational business is worth $9 billion. I just gave you $1 billion in cash, which means that the total company, the total private company, is worth about $10 billion now. And so, but I've given you $1 billion, and the company's worth $10 billion. So I basically should get 10% ownership in the company. That's just a basic fraction there, 1 billion divided by 10 billion. Now, the private company may say, no, we're not worth 9 billion, we're worth 10 billion. And so you can have this negotiation that goes back and forth. But if things work out, eventually the private company will agree to the deal, will allow me to take a 10% stake. And then what I do is I go to all the investors, all the shareholders in the SPAC. I ask them to vote on the deal. Normally they'll vote yes because they've already given me a blank check and they trust me. And so they will vote yes, the private company will agree. And then you do, to really complete the process, you do what's called a de-SPAC merger. And what happens in this is that the private company basically merges and begins to trade under the ticker of the SPAC. And so you have a private company that now trades on a public stock exchange under that SPAC ticker. It's a publicly traded company now. It didn't have to do an IPO. It knew what price it was going to go public at because that was part of the SPAC negotiations. And so everyone's happy. The private owners, maybe they can sell some shares now more easily and buy their yacht and their mansion and their airplane. And they can also tap the markets, the public markets. They could issue more shares if they wanted to raise capital, additional capital to grow the operations, to grow the business. Now, when you buy a SPAC, if you buy a blank check company, you usually don't know what private company the SPAC will merge with. They can't disclose this even if they know, because that would make the whole IPO process for the SPAC much more difficult and much more regulated. So it really is a blank check. You have to trust the SPAC sponsor you should research them and make sure you know what they're doing and that they have some experience in the industry. Maybe they said they're going to buy a retail company if it's a retail SPAC, or they're going to buy an e-commerce company or a transportation company, whatever sort of SPAC it is. And there's usually some sort of indication, like we are looking to buy a European manufacturing company or a Chinese manufacturer, etc. And so you have an idea, but you don't know when you buy the SPAC shares before the merger what company you're going to end up with, which is why it's obviously called a blank check company. Now, SPAC normally has 2 years to find a company to merge with, to do a de-SPAC merger. And if it doesn't find a company, the cash will get returned to investors. You'll get your $10 per share back. Now, if you have a good sponsor, they'll find a good company and they'll be able to buy it at a good price if they know what they're doing. If you have a bad or unethical sponsor, they're definitely incented to just buy any company. If it's been 23 months and they have 24 months before they have to return the cash to investors, they may just choose to buy any old company and spend the money rather than returning it to investors. This is because the sponsor gets paid usually a percentage of the shares, something like 20%. And so they're incentivized, they can be incentivized to just buy any old company. So you have to really make sure the sponsor is good management, and you have to make sure not only are they smart, they understand the industry, but they're not going to overpay for the private company, and they're also not going to buy just any company in order to get their fees. Now, when SPACs go public, when they issue units to the public and do an IPO, these units are usually packaged, and they're comprised of one share of stock. One SPAC unit equals one share of stock plus a partial warrant. A warrant is just like a call option. It gives you the option to buy shares of stock, normally at $11.50. As we said, the shares of stock are usually issued at $10 per share. The warrants, the strike price for the warrants is usually at $11.50. So you always need to do your due diligence and read the documents to find out what the actual strike price is. Typically, it's at $11.50. And so what this means is anyone who buys at the initial offering, they will get some shares of stock, however many they want to buy. They'll get some partial warrants, and these partial warrants are they're fractional. So one partial warrant may allow you to buy a third of a share of stock at $11.50. And so if you want to buy a full share of stock, you may need to collect 3 warrants before you exercise them. This is something that would be done later, probably after the de-SPAC merger, when the company is freely traded. And the only reason you would ever exercise a warrant as an investor in it is if the stock price was trading above $11.50. So if the stock is trading at around 20 or so, you get to buy the shares for $11.50, and then you can immediately flip them and sell them at 20. I tend not to deal with these warrants. When I buy a SPAC, I tend to buy the underlying stock, just a little easier to price. But the warrants obviously give you more flexibility. They're sort of a more leveraged way of participating in the company. That being said, if you're ever going to buy a warrant for a SPAC, you need to really understand the conditions under which you can exercise the warrant or convert it into shares. And these will be different for every deal, so you really have to know what you're doing. If you're finding this video helpful so far, I'd encourage you to hit that subscribe button, hit that like button, and also maybe share this video with a few friends. Now, SPACs do not have a good history of making money for retail investors. The sponsors, as we said, almost always make a lot of money. They get to take 20% of the deal usually. And then retail investors are often left holding the bag. They often don't know exactly what they're buying, and they may buy into the SPAC at such a high price that even if the SPAC ends up merging with a really good private company, they may end up having overpaid. Now, SPACs really took off after March 2020, and then they peaked. The peak in all these prices really happened in February. And then we've seen an unraveling, a popping of the SPAC bubble, where SPACs that traded at very high prices, it traded very far above that $10 NAV, maybe trading as high as $50 or $60, they've now come back down to earth. And so I think there's a lot of opportunity in this space, especially because a lot of the really dumb money has been flushed out and has lost money. Now you can find SPACs today that are trading below $10, below their actual NAV, and this is for pre-merger SPACs. If you buy shares of a SPAC at $9.50 and you don't like the deal, as a shareholder, you can vote no, and you can also sell your shares back to the sponsor right before the merger happens for $10. This is how it normally works. Again, you have to read the fine print. But what this means is you can buy deals now at $10 or close to $10 or even sometimes below $10. In my experience, the really good SPACs end up trading at a little bit of a premium to 10. But theoretically, if you read the fine print, one strategy would be to just buy a basket of SPACs trading below $10. So maybe you have $10,000 to invest in SPACs and you pick 10 SPACs that are trading below $10 a share and you buy 1,000 shares of each. And what should happen, what's 99% chance of happening, is that you'll either get a very good deal or they'll trade back up to 10 right before the merger, or you'll be able to redeem your shares for $10. So this is almost like a T-bill or like an interest bearing account where you can buy these at a discount, and then there's really that floor at $10. They can trade below $10 before the merger, but as you get close, you should be able to redeem your shares for $10. Now, once the merger is completed, the stock will trade like any other stock. And at that point, it could certainly go below $10. You only really have that put, that built-in put at $10, that floor before the merger. And this is what happened to a company like Nikola. They went public via a SPAC on June 4th of 2020. Right here, we can see on the chart where the SPAC merged with Nikola, which was the private company that's not publicly traded. The stock spiked for 2 days and then has since traded all the way down. So if you bought right here when the merger was announced, you paid something like close to $38, $40 for that. You made some money for a couple days. You almost doubled your money. And then it has sold off since then. And it's now trading at $12.80. And there's no floor here. The merger's already happened. And so this stock could easily go below $10. It's just like any other IPO. Once it's publicly traded, it can trade anywhere. So these kind of SPACs have not been these very hype SPACs where they purchase kind of junky companies like Nikola have not done well for investors. This is why it's very important to know who the management is and to trust the management of the SPAC. Someone I trust who's very smart is Peter Thiel. He has a SPAC called the Bridgetown SPAC that's looking to buy a Southeast Asian company. There's rumors they're in talks to merge with Traveloka, which is a little bit like Expedia. And so it's very important when you invest in a SPAC to know who the lead investors. In this case, it's Peter Thiel and also Richard Lee, both billionaires with a very good track record. If we take a look at where Bridgetown is trading, there are actually a number of ways to trade it. When it first came out, the company traded under just a unit, as we said. There were units. Each unit was combined stock plus a partial warrant, and these still trade under BTWNU. BTWNU. This is the combination of the stock and the warrant. And since then, it looks like back in December 3rd, December 3rd of 2020, they allowed you to break apart your units into shares and warrants. And so if you own these units, you could go to your broker or your custodian, break them apart and sell off the warrants and sell off the shares. Maybe you want to keep the shares and sell off the warrants. And so as a result now, the Class A shares in this SPAC trade under BTWN. We can see that these are trading at about an 18% premium to NAV. NAV is obviously at $10. This is a very highly regarded SPAC. And so your risk really here is it's about approximately 18%, a little bit less, because this can't really trade below 10. If you don't like the deal, if it does trade below 10, you can always put your shares back to the sponsor at $10 a share. And if they do a good job of picking their acquisition target or their merger target, this could obviously trade up quite a bit. The warrants, as I said, are trading separately under BTWNW. We can see here that these warrants expire. Their call options, they expire on September 30th, 27. I haven't dug down into this, but I believe they allow you to buy shares at $11.50. These tend to be quite illiquid. We can see in the after hours here, they're trading at 2.81 bid versus 420 offer. So they can be, I'm not sure when the market's open if they're more liquid, but these warrants are definitely usually something that retail investors should stay away from and just buy the underlying SPAC, the stock piece of it, BTWN. Now, I don't own this currently. There's another SPAC that I like a lot more. If this were to trade a little closer to 10, if we got a little bit of a stock market hiccup, it's something I might be interested in picking up some shares in. But if you followed along this far, you might be interested in learning about the particular SPAC that I just bought a couple weeks ago. This SPAC is currently trading very close to $10. So you have that built-in floor. A couple days ago, it was actually trading below $10. So there's a chance over the coming weeks that you might actually even be able to buy it at a discount to its NAV, which means that it's almost impossible to lose money on. If you can buy this below 10, you can be pretty sure that you'll get your $10 back if you don't like the acquisition target. But this is a SPAC that I think has huge upside. It's not one of the really popular ones. It flies under the radar. And this is really the best way to make money with SPACs. You can either buy a basket of them and a basket of them below $10 per share, redeem them at 10, or you can pick an individual one like I did, which I think has huge upside. I think this is a double or a triple. And this is now part of a new feature of Trader University where I don't just teach courses, but I also share the new stocks that I'm buying in real time. So when I buy a stock, when I enter, when I exit, I will share the date and the time, my entry price, and also my exit price. So far, I've only bought one stock under this. These are long-term investments that I'm sharing, my favorite long-term investments. And the first one, as I said, is a SPAC that's currently trading. It's currently trading actually below the price that I paid for it. And if you're lucky, you might be able to get it right around $10 or right below $10 in the next couple of days. If you'd like to get access to this, as well as getting access to all of my courses, which includes if you're a complete beginner, you should check out Learn to Trade Stocks Like a Pro. I have a very long advanced course on momentum stocks, how to day trade, how to make money with IPOs. If you want to understand a little bit better about how call options work, how warrants work, I have a whole sort of soup to nuts, A to Z course on how to learn to trade options, as well as how to learn to trade futures. So if there's something in the stock market, options market, futures market, or crypto market that you're interested in, it's almost certain that I have a course that addresses that. And so in addition to gain access to all these courses, you also get access to following my trades. You get to see my favorite momentum stocks, and you also get to see my favorite long-term investments, which I'm going to buy a new stock every 1 to 2 weeks if I can find a good target. These are ones that I'm buying with my own money, obviously, and I want to make sure that they're good long-term investments. So I won't try to force it, but you'll get to see in real time as I buy and sell these stocks. They'll generally have a holding period that's in months to years. So these are really long-term investments. Whereas the list of momentum stocks is really just the list of momentum stocks that I'm trading or that I'm looking to trade that have good price momentum and that are the strongest stocks in the strongest stocks in the market. If you're interested in digging down a little bit deeper, taking a look at what's inside of these courses, you can click on any of these boxes here and it'll give you access to the list of lectures. Just click on the link in the description notes below. It will take you to this page. You can browse the courses and really see what's inside of them in terms of lectures. And then if this is something that interests you, you can just go down to the bottom here, click Get It Now. And that will take you to the checkout page right here. Now, because you've listened to this lecture all the way to the end, I want to give you a special coupon code. Normally access to all the courses, my list of momentum stocks, as well as my long-term favorite stocks, long-term investments. You can get access to all of these normally for just $125 for 30 days. But as I said, I wanted to give you a special coupon code. If you click right here where it says have a coupon code and then you type in YT99, as in YouTube 99, that'll take $26 off. So you'll get access to all the courses and my list of favorite long-term investments, momentum stocks, for just $99 for 30 days. You can watch all the courses, you can write down the tickers and see the rationale for my investments in the long-term investment section, and then you can cancel and you won't be charged again. There are no long-term contracts, though I hope to continue to add new stocks to the list of long-term investments, as well as add new courses. So if you see something that's missing from the site and you'd like to learn more about that topic, you can let me know. I'll make a whole course or a lecture just for you. I'll post it on the website so everyone, all the subscribers, all the paid subscribers can have access to it as well. And this way I hope to really grow this to be the best resource online for new traders and investors, as well as intermediate and advanced traders as well. This is really the kind of resource that I wish I had had when I was first learning how to trade and invest 25 years ago. So click that link in the description notes below. You can check out Trader University Premium and see if it's a good fit for you. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.